So, you've probably seen those complicated-looking charts with all the squiggly lines and colorful bars and thought, what on earth is going on there? It looks like something only a Wall Street genius could understand, right? Well, what if I told you it's a lot simpler than it looks? And today, I'm going to break it down for you so that anyone can get a handle on it. This is called technical analysis, and it's basically a tool that helps people make educated guesses about where an asset's price might go next. It's not a crystal ball, it's not magic, but it's a skill that, once you learn the basics, can seriously change how you look at investing and trading. Imagine you're trying to guess if a ball will go up or down after someone throws it. You don't care who threw it, how strong they are, or why they even threw it in the first place. All you're doing is watching the ball's path, its arc, its speed, how it bounced before, and based on that information alone, you're trying to predict its next move. You're analyzing its past action to forecast its future action. It's pure physics and observation, nothing more. That's pretty much the core idea behind technical analysis. It's a bit like that, but for money stuff like stocks, crypto, or even gold. Instead of looking at a company's health, like its earnings reports or how good its CEO is, which is called fundamental analysis, we just look at the price history on a chart. We're looking at the patterns, the trends, and the behavior of the price itself, because the theory is that all the important information is already baked into that price movement. We're just learning to read the story the chart is telling us. So grab a coffee, get comfortable, and let's decode these charts together. Alright, first things first, we need to understand what we're even looking at. The chart is our canvas, our main source of information. The most basic type you'll see is a line chart. It's super simple. It just connects the closing price of an asset over a certain period with a single line. So, if you're looking at a daily chart for Apple stock, the line will connect the price where Apple closed each day. It's great for getting a quick, clean look at the overall direction, the big picture. Is it generally going up, down, or sideways? The line chart gives you that snapshot instantly without any extra noise or clutter. But if you want more detail, and trust me, you do, you'll want to use what's called a candlestick chart. Now, these look a little more complex, but they tell you so much more. Each candle represents a specific time period, like 1 day or 1 hour, and it shows you 4 key pieces of information. Media group. Close up on a single candlestick with animated highlights on open, close, high, and low points. Graphic overlay. Labeling candlestick components on a chart at stock at distribute_equally. The opening price, the closing price, the highest price it reached in that period, and the lowest price. The main thick part is called the body, and it shows you the range between the open and close. The thin lines sticking out the top and bottom, called wicks or shadows, show you the highs and lows. So, how do you read them? It's all about the color. Traditionally, if the candle is green, it means the price closed higher than it opened, a win for that time period. The bottom of the body is the open and the top is the close. If the candle is red, it means the price closed lower than it opened. In this case, the top of the body is the open and the bottom is the close. By looking at a series of these candles, you can get a much richer story about the battle between buyers and sellers and the momentum in the market. It's the difference between seeing a photograph and watching a movie. Now that we know how to read the charts, the next step is to identify the overall direction the price is moving. This is called the trend, and it's probably the single most important concept in technical analysis. The old saying is, the trend is your friend, and it's true. Fighting the trend is like trying to swim against a strong river current. It's exhausting, and you probably won't get very far. There are 3 types of trends you need to know. The first, and the one everyone loves to see, is an uptrend. This is like watching someone walk up a staircase. They take a few steps up, then maybe 1 step down to catch their breath, then a few more steps up. On a chart, this looks like a series of higher highs and higher lows. The price pushes up to a new peak, pulls back a little, but not as low as before, and then pushes up to an even higher peak. The opposite of that, of course, is a downtrend. This is the one that makes people nervous. Think of a ball bouncing down a flight of stairs. It drops, bounces up a little, but not as high as where it started, and then drops even further. On a chart, a downtrend is defined by a series of lower highs and lower lows. The price falls to a new low, rallies a bit but can't reach its previous high, and then falls to an even lower low. Identifying a downtrend is crucial because it tells you that the sellers are in control, and it might not be the best time to be buying, at least not until you see signs of the trend changing. The third type of market is a sideways or ranging market. This is when there's no clear direction at all. The price is just bouncing back and forth between a relatively stable high point and a low point, like a ping pong ball being hit back and forth across a table. There are no higher highs or lower lows, it's just choppy and moving sideways. This indicates that buyers and sellers are pretty evenly matched, and the market is in a state of indecision. Recognizing these different trend environments is key, because different strategies work best in each one. You wouldn't use the same approach in an uptrend as you would in a sideways market. So we know how to spot a trend, but how do we know where the price might stop and turn around? This is where the concepts of support and resistance come in, and honestly, they are fundamental. Think of it like this. Imagine a rubber ball bouncing in a room. The floor stops the ball from falling any further and causes it to bounce back up. The ceiling stops the ball from going any higher and sends it back down. In the world of charts, support is the floor and resistance is the ceiling. Support is a price level where a downtrend can be expected to pause due to a concentration of demand, meaning buyers are stepping in. When the price of a stock is falling and it reaches a certain level where it consistently stops falling and starts to bounce back up, that level is called support. It's basically a floor where buyers see value and start buying, which overwhelms the sellers and pushes the price up. The more times the price hits this floor and bounces off, the stronger that support level is considered to be. It's like a historical price point where the market has decided, nope, we're not letting it get any cheaper than this. Identifying these floors can give you potential areas to consider buying, or at least to watch for a potential trend reversal. On the flip side, we have resistance. This is the ceiling. Resistance is a price level where an uptrend can be expected to pause or reverse due to a concentration of supply, meaning sellers are cashing out. As the price moves up, it hits a point where sellers think it's gotten too expensive, and they start to sell their shares. This selling pressure overcomes the buying pressure and pushes the price back down. Just like with support, the more times a price hits this ceiling and gets rejected, the stronger that resistance level becomes. These levels are super important because they are the battlegrounds where the future direction of the trend is often decided. Now let's add another layer to our analysis: volume. Price tells you what is happening, but volume can often tell you how strong the conviction behind that move is. Volume simply represents the total number of shares or contracts traded during a specific time period. On most charts, you'll see it displayed as a bar graph at the bottom, directly below the price action. Each bar corresponds to the candlestick or price bar above it. A tall volume bar means a lot of shares were traded. A short volume bar means not many shares changed hands. It's a measure of market activity and interest. Think of it like the roar of a crowd at a sports game. If a team scores and the crowd goes wild with deafening cheers, you know it was a significant, exciting moment. If they score and there's just a polite clap, it doesn't feel as important. In trading, high volume is the roar of the crowd. When you see a big price move, either up or down, and it's accompanied by very high volume, it suggests that a lot of people are participating and there's strong conviction behind that move. This makes the move more significant and more likely to continue. A price move on low volume is like that polite clap. It's less convincing. Volume is incredibly useful for confirming trends and patterns. For example, if a stock is in a strong uptrend, you typically want to see volume increase as the price rises and decrease as the price pulls back. This shows enthusiasm on the way up and a lack of interest on the way down, confirming the uptrend's health. Conversely, if a stock breaks through a key resistance level, you want to see a huge spike in volume. That spike is the confirmation, the market shouting, "Yes, we believe in this breakout." If it breaks out on low volume, you should be skeptical, as it could be a false breakout that quickly fails and reverses. Always check the volume. It adds crucial context to the price action. Okay, let's get into some of the specific tools and patterns that technical analysts use to make decisions. One of the most common tools is the moving average. A moving average smooths out the price data to create a single flowing line, making it easier to see the underlying trend. A 50-day moving average, for example, shows you the average closing price over the last 50 days. If the current price is above this line, it's generally considered a bullish signal, and if it's below, it's bearish. Traders often use two moving averages, a short-term one and a long-term one, and watch for when they cross over as a potential buy or sell signal. Another popular tool is an indicator called the Relative Strength Index, or RSI. This isn't plotted on the price chart itself, but in a separate window below. The RSI is a momentum oscillator that measures the speed and change of price movements. It moves between 0 and 100. The key levels to watch are 70 and 30. When the RSI goes above 70, it suggests the asset might be overbought and could be due for a pullback. When it falls below 30, it suggests it might be oversold and could be due for a bounce. It's not a perfect signal to sell or buy, but it's a great warning light that tells you when a trend might be getting overextended. Finally, analysts look for recurring chart patterns that can signal a potential reversal or continuation of a trend. A famous reversal pattern is the head and shoulders, which looks like three peaks, with the middle one, the head, being the highest. This often signals the end of an uptrend. Its opposite is the inverse head and shoulders, which signals the end of a downtrend. You also have double tops and double bottoms, which look like the letters M and W respectively. A double top is a bearish reversal pattern, while a double bottom is a bullish one. Learning to spot these patterns can give you a heads up before a major trend change occurs. So, that was a whirlwind tour of the basics of technical analysis. We've covered charts, trends, support and resistance, volume, and a few common tools. It might seem like a lot, but don't feel overwhelmed. The key is to take it one step at a time. My best advice for anyone starting out is to focus on the absolute fundamentals first. Before you even think about complex indicators, learn the super simple stuff first. Master reading candlestick charts, identifying trends, drawing basic support and resistance lines, and always checking the volume. These are the building blocks for everything else, and without a solid foundation, the house will crumble. The best part is, you can start learning and practicing for free, right now. Look at charts on free websites like TradingView, which is an amazing resource. Pick a few stocks or cryptocurrencies you're interested in and just watch them. See if you can spot the trends and the support and resistance levels we talked about. Then, take it a step further and use a paper trading account to practice. This is basically using fake money to make real trades. It's the perfect way to test your strategies and learn from your mistakes without risking a single dollar of your hard-earned cash. There is no substitute for practice. Finally, and this is the most important part, always remember risk management and be patient. Before you ever enter a trade, you must know exactly how much you're willing to lose on it. This will save you from emotional decisions and catastrophic losses. And understand that getting good at this doesn't happen overnight. It takes time, it takes screen time, and it takes making a lot of mistakes. Technical analysis is a helpful tool to understand what prices might do. It's like having a map for the market, but remember, no map is perfect. It's a game of probabilities, not certainties. Thanks for watching, and I'll see you in the next video.